What is going on with fixed rate mortgages right now? It's insane. I've never seen something like this in my career. So I thought I should talk about it here today on the channel because the fixed rate products, which are normally tied to bond yields, seem to be decoupling. They seem to not be doing what they have done in the past. And I have some theories on why I think that is the case. I could be wrong. These are just my experience in the marketplace, but I am seeing a big change from where we have been in the past. And that's what we're going to talk about in today's video, because let's face it, a lot of people are scared right now and they want to lock into fixed term rates. Maybe that's part of the whole thing that the banks are seeing right now and why they're doing what they're doing. So let's hop into that right after I ask you to subscribe to the channel. If you would like to stay up to date on the Surrey and Greater Vancouver marketplace, click the like button to help me get this video out to more people. And of course, if you are looking to move within Surrey or the Fraser Valley or all of Greater Vancouver and you need help, well, you can book a call with me right now using the link in the description below, because I'm a real estate agent and my team would love to help you make your move. So let's get into what I'm seeing. And when I mean decoupling, we are seeing the rates that are being offered by the bank, and then we're seeing the bond yields. The fixed rate product is supposed to be tied to the bond yields. As bond yields go down, we should see fixed rate products going down. But as bond yields have come down and have continued to come down, the banks seem to be, for a while there, let's say, I don't know, maybe last September, when the bond yields came down quite a bit, they were lowering their rates, and we saw as low as like 3.99% on an uninsured mortgage. There's insured and uninsured. Insured mortgages are higher ratio, so they're somewhere between up to 20% down. So a lot of 5% down, 10% down. First-time buyers will get an insured mortgage. That insurance means the bank has no risk, and therefore what you thought would be when you put more money down, you would get a better rate. It's not the case. Because of the insurance, the money is guaranteed to the bank. They're giving lower rates to those people that have government-backed insurance. But what we're seeing lately is the banks are not following the current downturn in the 5-year bond yield. And I can't really understand why they would do this. I have some suggestions. I do have some suggestions for why I think that is. First off, right now there's unprecedented uncertainty out there in the economy with things like tariff threats, trade war threats, a very low Canadian dollar, a weakening economy anyway, a future election coming up for us sometime within the next, hopefully 6 months, maybe a little bit longer. Whatever that timeline is for that to happen, we are in a massive time of uncertainty right now. As a result, I think the banks are also uncertain. The banks then are going to try and juice as much of that risk out by charging people higher rates for longer. There's nothing that I know of that says they have to tie those rates to the bond yield. It's just traditionally always been done that way. When one bank moves, the rest of them usually follow suit. Right now, nobody's really moving. There's some, the rate hub stuff out there where you've got some shady tree lending service or some bank you've never heard of that's got some unreal expectation of a rate that you're never going to get, but they're going to use it as advertisements to bait and switch you into something else. There are those mortgages, and I shouldn't say bait and switch because those mortgages are real. It's just not many people are actually going to qualify for those mortgages, or they're so restrictive that nobody wants those mortgages. So then they get into higher rates. So what we're seeing right now is a bond yield that was hovering in and around 3%. And last time it dropped down to like 2.6 or wherever it is now, you could get somewhere around a 3.99 to maybe a 4.09 5-year fixed rate mortgage, or a 3-year fixed rate mortgage at least. But at this point in time, the bond yield has come down, and I'm still seeing mortgage rates right now at, let's call it 4.5, give or take, but the actual ones being given to our clients who are uninsured mortgages, so they have 20% down or more, like they're lucky to get a 4.4 mortgage. They're probably not getting that. They're getting, let's call it 4.49, 4.59, something like that. So even though the bond yields have come down, we're not getting the discount that we should be getting. And again, I think this is happening as a result of all the economic uncertainty, the trade wars, the tariffs. But then there's this one other thing that I think is likely another reason why this could be happening. And that is there is a lot of mortgage renewals happening in 2025. There's a whole lot of people that bought at the peak of the market. They're seeing lower rates. They've refinanced into higher rates maybe a year or two ago. They were riding a variable for a long time. There's and then there's just the people that, were just set to renew anyway, right? All of these people are renewing right now. So we're seeing a higher than normal renewal rate. And as a result, I think the banks are juicing that interest rate because they know that these people, well, they need to renew and they're going to hold on to these higher rates as long as they possibly can. I do still think those rates are going to continue to come down. I'm seeing them come down for my renewal. I'm in this boat with a lot of you out there. But at this point in time, it looks like the banks are holding on. So there is a gamble out there. If you're renewing this year, there is a gamble out there. Do you float it on a variable in hopes that those rates come down and then lock in 6 or 9 months or 12 months from now at maybe in somewhere in the threes? That might happen. However, I think right now, if you can lock into something below 4.5%, you're probably doing good, even though I don't think the banks are doing their part in lowering the rates as low as they should be for you if you're renewing right now, or at least at this point in time, but let's call it all the way up until possibly even summer. Now, I don't know if this is all true. This is just my theory. This is where I'm looking at. I'm not a mortgage broker. I'm a real estate agent. But I do think that this is turning a lot of people off of fixed rate products, and they are considering variable rate mortgages right now. If you are considering a variable rate mortgage, you should watch this video right now for the reasons that you should take a variable rate in 2025.